Hello, everyone. Welcome to the latest of our Artemis Live video interviews. Today, I'm delighted to be joined by two members of the specialist insurance-linked securities fund manager, 12 Capital. We're delighted to have Dr. Urs Ramseier, founding partner, CEO and CIO of 12, and also Florian Steiger, director of the cat bond strategy at 12. Thank you both for joining us.
Thank you very much. Yeah, for the opportunity.
Good to see you both. Hope both of you are well. I guess, as with all of these interviews, we should start with some reference to the pandemic. So I thought it'd be interesting to hear from you sort of how that presented challenges to 12 Capital, what you guys did to respond and the team there, and how you look to help your investors and also cedents at this time.
Yes, sure. Thank you very much. So obviously, the whole lockdown came a bit as a surprise to us, as to everybody, at least the speed of it. It was quite a smooth transition from a company perspective to home office. So everybody has been working in the home office since then. In terms of investments, what we did was the first few weeks, the focus was clearly on client retention. So basically, we were very active publishing research notes. How do we assess the situation on the portfolios, on the cat bonds on the one hand side, but then even more on the insurance bonds, our credit strategies and equities, where the volatility was much higher than on the cat bonds. In terms of insured risks, obviously at the beginning we were thinking about mortality risks, right? So we went through the portfolios in terms of mortality. But then after a few weeks, the focus was then more on the non-life side of things in general, and in particular the topic around business interruption. And there we published also a research note on that topic and the impact on cat bonds, but also the private ILS business. We identified three type of exposures potentially. So one hand side, the policies where pandemic is explicitly excluded, so there we do not see a big risk. And then on the other hand of the spectrum, where it's explicitly included, so the type of big event coverage. And then there's a whole range in between in this area where it's not clear whether it's excluded or included, and where there is some uncertainty. We still believe it could be a significant exposure to the industry, this business interruption claims, but the uncertainty is still very high, and what the impact is on the ILS portfolios. We're very confident on the cat bond portfolios that we do not see major impact there, but on private ILS it remains uncertain.
Any feeling how long it could take for the uncertainty to sort of clear a little bit?
I can take long. I mean, still in certain countries there is some legal clarity on its way, but I think what makes it difficult is there are different generations of policies out there, right? With different wordings, so it's even very difficult for the companies themselves to have a clear view what the real exposure behind is. And then there is also the situation then in certain countries, insurance companies pay regardless whether there is a strong legal case or not. And what does it then mean for insurance? What does it mean for ILS portfolios? There's a whole chain which is still highly uncertain in our view.
Absolutely, yeah. No, it's certainly something that everybody's thinking about right now.
Yeah.
On the sort of cat bond market in particular, obviously the sell-off that we saw created some opportunities. How did 12 manage that opportunity and that sort of moment that occurred?
Yeah, it definitely created an opportunity. I would even say it created two opportunities, in fact. The asset class itself has become an even bigger opportunity if you compare to high yield bonds, corporate bonds, and any other fixed income assets. Obviously, finding a non-correlated asset class in an environment where volatility has massively spiked up in financial markets itself is of an even bigger value today than it used to be before. So we see a lot of investors taking a look at cat bonds on an asset class level and say this is now a better opportunity than it was before. And even within the asset class itself, obviously we have seen quite a high level of trading activity, particularly in March. For us, that was a rather fortunate moment in time as we enjoyed inflows into our cat bond strategies, and we were able to deploy substantial amounts of cash into an overall rather weak secondary market. So it was one of the rare moments in time when you can really pick whatever you would like to buy in the cat bond market, and most likely you will find an offer out there. So that has helped us to ramp up the portfolios and to rebuild portfolios slightly, and also to reposition portfolios for the upcoming hurricane season.
And a lot of those opportunities were at quite attractive pricing as well, I would imagine, in March.
Absolutely. And interestingly enough, the cat bond market has been repricing for the past 3 years now. Previously more for fundamental reasons, this time more due to a lack of liquidity, or to some due to some investors reshuffling out of cat bonds into credit or into the equity markets. But it was definitely a very good moment price-wise to pick up certain paper in the secondary market. And also when they're up in the primary market.
Yeah, and that seems to be continuing now as well. All of the recent bonds appear to be pricing quite attractively too.
Yeah, that's correct. So secondary market prices have an influence on primary market pricing, but it's not only the pricing which is particularly attractive right now, it's also the structure of the underlying bonds. And as it is typical in a hard market, pricing is one thing, but then legal structure, trigger structure, and all the fine legal print, which is an important part of our investment process, that's also much better now than, for example, if you compare to pre-HIM in 2017. So that's certainly an improvement on all sides here.
Great, thank you. So obviously 12 Capital has not just cat bond strategies, you also have private ILS strategies, but you invest across the sort of risk return spectrum and balance sheet of insurance and reinsurance markets as well. So has the pandemic also presented opportunities for you across your debt and private equity strategies?
Yes, of course. I mean, the volatility on the insurance bonds, the debt strategy was much higher than in cat bonds, right? When Florian talks about high volatility, then that's all relative what we see on equities and insurance bonds. So spreads have massively widened in the credit strategies. However, we believe there is no reason to think there will be defaults or massive defaults in the insurance sector. I mean, the solvency ratios are very high, are stable, are solid. So we do also not expect any deferral of coupons. So we believe on the insurance bond strategy, the current spreads really offer an opportunity, a great opportunity to get invested. Also, if we think about interest rates, we believe that interest rates will stay low for very long. If we look what the central banks are planning and doing, so once the crisis is to a certain degree over, then people will think again, where can they get yield? And then the insurance bond strategy will be very attractive. The picture is a bit different in equities. Here is the same then. Generally on also on ILS, the whole business interruption topic is a big one for certain companies. And until we have more certainty how big the claims will be and the losses on the non-life side, I think stocks will not fully recover. The interesting part then was on some of the Lloyd's companies and reinsurance companies to recapitalize by rights issues, capital increases. So we saw Hiscox, Beazley, we saw Renry. And obviously, it will be interesting to see what it does to the pricing in the insurance industry. This additional capital they raised in the equity markets.
Which I suppose it's an interesting dynamic with debt and equity, that the timing is perhaps much more difficult to judge than sometimes with catastrophe bonds and ILS, where we have a single loss-related factor that you can look at the dynamics of the market and maybe make decisions fairly quickly to move in, where with debt and equity it takes a lot of research as well around that to see what is happening more broadly in the economy.
Exactly.
Yeah, it's an interesting area. And is this something that 12 continues to look to expand on, the debt and equity strategies there?
Yes, of course. I mean, the debt strategy is something we have been doing since we founded the company in 2010. It's one of our pillars. I also believe we're market leader in that strategy. So it's a good opportunity to invest within investment grade fixed income. Solid yields. We have never had a default in Europe of an insurance bond, a listed bond. So I think it's a great opportunity. Obviously, we have also synergies between our equity debt strategy with the cat bonds and ILS. I mean, what we have seen over recent years, especially on the indemnity cat bonds, indemnity transactions, you have to be very careful and also look at the quality of the cedents, right? The corporate governance, and that's where we also get input from our colleagues on the equity and debt analytics.
Interesting. Yes, so there's some relationship between the two and the decisions that you make. Yeah. So moving on to the reinsurance renewals. Obviously, we've just been through the Florida renewal, and that was clearly pricing was very attractive again there. And people are saying that July 1st renewals will be similarly attractive. Do you feel the risk-adjusted returns are now more realistic for the risk that you're assuming?
Yeah, I would say realistic is a relative term, and from investor perspective, returns can always be higher. So certainly we enjoy returns going up, and but looking at the asset class as a whole, it's a question of what is an adequate return for the risk you are taking. And some people would argue maybe you want to earn in cat bond space 3% above risk, maybe 5, maybe 7. Others might even argue maybe you don't want to earn any excess spread at all because the asset class is diversifying as a whole for multi-asset portfolio. So I'm not sure if it's realistic, but it's certainly compensating very well for the risks one is taking, not only for the event risks, but also for structural risk, legal risk, and the whole topic of the Florida specific issues around loss adjustment expenses, AOP, etc. So I think they're now getting very well compensated across the portfolio, and I would be surprised to see that moving up even higher if we get a good hurricane season.
Sure.
I mean, on the one hand side, the spreads have gone up, but what is also important for our investor base in Europe and are the hedging costs from dollar into euro, right? And these hedging costs have come down significantly, so the returns in euro in Swiss francs are even higher. So we have got the spread widening and on top the reduction in hedging costs. So the space has become very attractive for European-based investors.
Interesting. So that could attract new investors potentially to the sector. Yeah. Okay. And so was 12 able to grow the private ILS portfolio at this renewals?
The private ILS portfolio is rather stable, but we see a very strong growth in the cat bond funds. I mean, the crisis has shifted in investors probably more to liquid funds, right? Because the liquidity was there when they needed liquidity in March. That's a big advantage. And the spreads and the yields are similar on a risk-adjusted basis right now than in private ILS. So we see very strong inflows in our cat bond portfolios.
And do you think opportunities are going to continue to be attractive right the way through the end of this year?
Yeah, I think that depending on the hurricane season, obviously. So what's an opportunity right now can turn into a very bad situation rather soon if we get a Cat 4 moving towards Miami. Obviously, that is not the base case. The base case is that in the long run, this will be very attractive. And I would expect the opportunity set to be even there after the hurricane season this year. Now, if it turns out to be indeed a good hurricane season, meaning only a few hurricanes or no hurricanes, or at least no major hurricanes making landfall, then I would expect spreads in the cat bond space to remain stable or tighten further. Because to expect them to widen out even further, if you look at relative value across other asset classes, I think cat bonds are extremely attractive right now. And I don't see any fundamental reason why they should blow out even further. So from a point in time perspective, the cat bond space is most likely the attractive we have seen in many years. And in the future, it might turn out that this is now one of the best entry points in the foreseeable future as well.
Sure, and I guess with cat bonds as well, it's good that the spreads remain sort of commensurate with traditional reinsurance alternatives as well, which suggests that cedents will continue to look to the capital markets.
Yeah, in fact, we see more cedents coming to the cat bond market now that when a lot of private ILS capacity seems to be constrained, either from money which has left the sector outright in favor of cat bonds. So we see a lot of funds out there which have redemptions. At the same time, we see a lot of cat bond funds which are growing their asset base. And as such, the cedents are also looking to follow the capital. And hence, it's not a surprise that the issuance tables this year look the way they are. So if all things turn out well, this might even be a record year in terms of leadership for cat
And
bonds.
there is still a lot of trapped collateral in the private ILS portfolios, right? That's also not available for renewals or investments into the space. And the end investors, they're still are looking at what happened the last 3 years, and it's not easy to raise capital in the private ILS space right now. It's the interest is really on cat bond portfolios from end investors.
And that in turn should stimulate more cedent interest as well if they see the capital flowing to the cat bond market, which is all very positive for future issuance. So, I mean, yes, we potentially could have a record year again this year, and I know 2021 is another quite high level of maturities coming too. So it does seem like investors may increasingly look to the cat bond market. Are you sort of, your funds are open at the moment? Are you constantly finding new interest from investors?
Yes, both. The funds are open. We are seeing inflows into the funds, and from a portfolio manager perspective, this is a very happy moment of time when we can go to the primary market. New bonds are coming at record spreads. We can go to the secondary market and pretty much choose what we want to buy. So it's a very good situation right now, and we appreciate that a lot of clients are now looking into the space and coming into the space before the hurricane season to position themselves.
Yeah, so the real test will be if we can get a flow of new issuers, new sponsors as well coming, then that really bodes well for the next few years, usually with cat bonds. Do you expect traditional reinsurance and retrocession to continue firming, and how do you have any feel for when the sort of private ILS strategies may return to growth as well?
Yeah, I mean, I think it depends again on the hurricane season whether we see further increase in reinsurance premium going forward, right? I mean, if we look at the capital raise now on the equity side by certain companies, I would rather expect to stabilize if we get let's say a normal hurricane season. So no further increases, but let's see. I mean, it's probably not the moment just ahead of the season to make these kind of predictions. I mean, capital coming back, we speak to a lot of investors. They see now the price increases, they see the attractiveness, but you have to offer something which is clean of trapped collateral and potential losses from previous years' loss creeps. And then there is clearly interest from end investors again.
Yeah, and I guess the interesting thing will be to see how the market behaves over the rest of this year into January if capital does start to flow again into those strategies, and you also have continued equity and debt raises on the traditional side. Can the market install a sort of floor on pricing rather than chasing it down again like sort of 2012-13?
But again, it depends on the hurricane season, right? If you get if you did get a 50 billion industry loss now over the next few months, then obviously it would look different.
Sure. No, good. So the investment proposition is clearly looking very good for ILS across the board at the moment, and your debt and equity strategies as well. So on the investor side, you're seeing increased interest now, and what are the questions they're asking you at the moment?
Florian, on the cat bonds?
Yes, on the cat bond side, we see a lot of investor interest right now. Some of the obvious questions are related to the market technicalities over the past 6 months, especially market liquidity. Can we actually trade the market if investors want to go in or go out? And I think there the good answer is yes, we had plenty of liquidity in secondary markets, even in March. It did come at a price. Typically, we saw bonds being sold at a discount of, call it 1 to 5%, with the average probably being around 2 percentage points. But that is not a higher discount than what you would see in the high yield or in the corporate bond market at the same time. So I think on the liquidity side, cat bonds looked fine. And again, they have proven that it is an asset class which is liquid enough for the typical weekly liquidity that is in most cat bond funds. So I think that's a major stumbling block for many investors still, and it's now moving past the passing mark. And going forward, the whole topic of ESG integration, sustainable investing, integration to the investment process, climate change. These are some of the very key topics that we are working on and which are of huge interest to the investor community, because nobody wants to be caught in asset class which is exposed to natural event risk, and then all of a sudden we see tornadoes, hurricanes popping out all over the map as a result of climate change. So these are topics that the industry needs to carefully handle. We are working on that as well. I'm sure Urs, you will elaborate on that in a second. But these are key topics and key questions in the mindset of many investors for us.
Yeah, the question about climate change comes up almost in every investor meeting, right? Especially when you think about how much of the portfolio is exposed to U.S. hurricanes or other climate-related perils. So it's a big topic in the mindset of the investors.
Yeah. Are investors asking you about climate and ESG across the debt and equity side of the strategies as well? Are they interested in who the sponsors and beneficiaries are there?
Yes, it's across the different investment strategies. It's also across geographies from where the investor is based. I think climate change is a big mega trend in the financial industry for the next 10, 15 years, actually. So we have to address these issues and questions, yeah.
Yeah, and I suppose also that does present some opportunities for risk transfer as well, because large asset owners and investors are going to be looking to protect themselves against climate change as well.
Yes.
Yeah. So where are you seeing investors looking to allocate across your strategies at the moment, or is the focus really cat bonds at this point in time?
I mean, there is a clear focus on cat bonds. That's for sure. That's where we see a lot of interest, and also in the insurance bonds, credit strategies. So people who now think beyond the Corona crisis. So where do I get yield, right? In a negative or zero yield environment, and then also our multi-asset class portfolios. Where we can invest with regards to the seasonality of the hurricanes, but also be more proactive when the storm is on the water on the equity side of things, in the reinsurance stocks where we see opportunities. So these are the three areas where we see most interest.
And so the focus for 12 moving forward through the rest of this year is, I guess, watch the Atlantic and see what develops, and try and make the most of the market environment. Is that correct?
Yeah, that's certainly the focus for the next 3 to 4 months, and then assess where the industry is in terms of pricing, right, for the January renewals, and then position the portfolios accordingly.
Yeah, and what would your closing message for investors be at this point in time? If they're looking at ILS as a strategy, what would you say to them?
I mean, it has never been as attractive than now for the last 10 years, right? I think on a risk-adjusted basis, the returns are very attractive, even without the diversification benefit you get in addition to that, diversification towards other asset classes. So it's certainly a very good entry point right now into the ILS space, in both actually private ILS and the cat bonds.
Yeah,
great.
I would agree with that. I think if one's afraid of a potential global recession or depression in the real economy, there's potentially not a better place to hide from that than in the ILS space, be it cat bonds, be it private ILS. But here you have a diversifier which is paying an extremely high spread. And if you're looking at traditional portfolio construction theory, that's almost the holy grail of finding it for your portfolio. You find a high yielding diversifier which is paying the highest spread it has potentially ever paid. At a reasonable level of diversification. I think that's a very good value proposition to look at.
Great. Okay, well, look, thank you both very much. Really enjoyed talking to you this morning. Thank you, Urs. Thank you, Florian. And I wish you both well and hope to talk to you soon.
Yeah, thank you very much. Have a good day.
Bye.
Bye.
Thank you.